Good day, chartists. Welcome. I'm Greg Schnell, the host of the Market Buzz. Here's the show that looks at weekly setups across the U.S. market. Using the tools available on stock charts, we'll be looking for long time frame trades. Please subscribe to my articles and Twitter feed. You can also enter comments in the chat room for me to answer at a later date. Well, we've had just a couple of down days since the Fed meeting. And so we're trying to work our way through that. I'm going to cover off a little bit today. The Canadian market cracks, and I think the biggest thing that investors should enjoy about being a U.S. investor is that most other markets in the world crack before the U.S. market. And so when the other markets start to crack, at least be aware of the trend change in those charts and how that might help you get better positioned for investing on U.S. stocks. I showed it on Wednesday, but defensives are kind of been leading the group. We'll see if some of the technology bounce today from Amazon can carry over and start to shift the offensive, but defensives look like they're leading. And energy continues to look weak, might bounce today because oil's trying to bounce off the 200-day moving average. But I think the bigger issue we've got here is just broad weakness across the globe. And lastly, what we're going to focus on today is just working through the NASDAQ in a few different ways and how you can use that to help your setups and finding what you want to find. So hopefully there will be some information there for you that makes that a lot clearer. So the thing I want to point out today, let's just start with the Canadian market. And there's a reason to start here. And the big thing that I want to point out is there's two different things going on here. Here is the percentage of stocks above the 50-day moving average and the percentage of stocks above the 200-day moving average. And what we see is that when you fall below 50, usually, if you can imagine on any group, if the majority of the stocks are below their 50-day moving average, the market's getting a little weaker. And so what we saw back in January 2018 was we were up nice and high, and then a sudden shift below. Spent a couple days there and then literally moved down quite quickly into that low in February. And so that was kind of significant. And then the percentage of stocks at the same time above the 200-day were up around this same 65 level and then proceeded to roll over. There we go down and back up, and we come up, and right in here, we start to test a prior high. And we break out briefly and then give it all back. And then what happens up here is the charts are weakening, but still holding up okay. Then we literally make our high. And as we do that, we have less percentage of stocks above the 200-day, but we have a single spike, and then we gently pull back. Now, we don't know on this pullback how far it's going to go. The one thing that's starting to happen in here is the trend line breaks. And so as this starts to underperform, that starts to get the setup for things to really break down. And again, this market stayed pretty positive until it got below this 50% level. And so through all of this, the percentage of stocks above the 200-day kind of topped out at 65%, and each index is different. So we'll talk about that in a bit. But as this starts to unwind, you can see the problem, and it was in September. The Canadian market started to really lose strength in September, and obviously the U.S. market broke in October. Sometimes you get a 2-month warning with this Canadian market. Sometimes you get a couple of days. But more importantly, I think, is just the fact that Canada sells a lot of stuff to the U.S., and so it can help be a leading indicator of weakness that might start to show up in the U.S. And again, if it's 2 months from now, you don't need to worry. If it's next week, then maybe you want to think about it a little bit more. But again, here is the percentage of stocks above the 50-day moving average. Nice big pile up here. And all of a sudden now we're breaking down below 50. Now that in itself doesn't seem, that ominous. We did that in August. But again, that was already after the market had made its highs. And so rarely do you get down below 50% in an uptrend. And so, this is on the way up, but once you kind of up in this 60s level, it doesn't really get down to below 50 without some sort of a pullback. So that's where we are now. And again, we had over 65% of the stocks above their 200-day moving average, and now we're starting to pull down. This isn't that weak yet. You could probably get down into this 55 level, but what's more important is the percentage of stocks up here. And one of the ways to graphically represent that is to keep track of the percentage of stocks above the 200-day moving average, this ratio, the 50 and the 200. And when it's climbing, that's very bullish. I can't quite squeeze it on this screen here. Let me just see if I can shrink that down. So when you see this really starting to outperform, so it goes above 1% or a 1 ratio, this is basically many more stocks are above their 50-day than above their 200. This is very bullish. You're rising. And then it starts to pull back. And when it goes below this 1, so both of them are, or there's more stocks below their 50-day than below the 200, it's starting to pull things down. And in a very long rally, this thing will start to flatten out and it won't help you much. But in short bursts like this, it's quite helpful. And you can see that we've now broken below this 1%. This one level. I had 2 kind of cautionary areas because it can jog in here, but we already went straight through that down into the 0.8 area. So this is quite cautionary. And again, looking at the percentage of stocks above the 200-day, that's really started to break. Now, we also have the high-low indicator. What happens on the high-low is you keep track of the percentage of stocks above and below. Well, this is now below 0 as the trend line's breaking. And we saw this back in June where we dipped below the 0 level, went on one last rally for a couple of days and then rolled over again. So, maybe there's that one rally. I will say that we've had declining highs for 2 months already. And back in this June case, it was a marginal decline so far. Whereas, I feel like we're farther over here. We're kind of 2 months out and we're just starting to get the decline. So I think we're closer to the highs than perhaps 1 or 2 more rallies. And then back in January, there was no real clue from the net new highs. It was basically spiking on the day we made the high, and then it was up around 25, and it literally fell off. Well, if we go look at the U.S. charts, they're much stronger than this currently. But the idea would be, we're just not getting this big bull market thrust, and that's what bothers me. And so we continue to drift in this lower level here, even though the market made new all-time highs. This was for the New York Composite. We're just not getting this sort of big bull boost. Now, seeing the Canadian market break down next door just makes it aware that all things are not well. And if we looked at the Canadian market, what I should have done was just unwound that for you for a little bit. Back into 2016, what you see is this big bull thrust here that the U.S. market also enjoyed. And then we've been able to get rallies going, but we haven't been able to get a big new long thrust going in a bull market. And so the US market is stronger than that, but my point would be this Canadian market starting to roll over. And one of the things that I heard on Fast Money last night driving around was that the PMIs globally have declined every month for 12 months in a row and are just barely above 50. And so the Purchasing Manager Index worldwide kind of gives you an idea of economic activity. So having that kind of a big pullback, I think is important to be aware of that trend. And so while the U.S. market is doing really well on software and that kind of stuff, the real question is, can it hold up? And I think even Jay Powell mentioned slowing in manufacturing worldwide. So all of this sets up that I think it's something to be aware of. And then the last chart that I want to show you, and I'm just trying to find it here, is the advanced decline issues. And what's happening in Canada is we've got this big sharp drop off on the right shoulder. And we saw this in 2015 as well, where as we tested the prior highs, we made a lot lower high in the advanced decline line. And again, when the market finally dried up and we started to push lower on net new highs, that was kind of confirmation that everything was getting pretty weak. And so here we've rolled over. Now, the real question is it done? Well, maybe it rallies again. I think the most important thing is with lower highs every month for 2 months already while the US market's been rallying, it's quite clear to me that it seems pretty weak. And we need to be aware of the potential for a big rollover in Canada. And again, if you look across the Canadian sectors from industrial metals and oil and that kind of stuff, those stocks have been falling quite precipitously. Anyway, the big clue for U.S. investors is that if you're one of your largest trading partners, because we sell quite a bit into the U.S., if that's starting to slow significantly, how much will that affect the U.S. markets? And I think, if everybody pushes into the U.S. markets, that works well. One of the things we found at the September top was all of a sudden the tech stocks started to underperform. And so with that underperformance is a specific problem. So I just want to go, I thought I had a tab set up and maybe I already deleted it. So I'm just going to go grab one here, charts and tools, and just keep looking at this perf chart just to watch where the price action is going. And so this is for 200 days, but let's set it up for the past week. And what we see here is, this is compared to the S&P, and this is the absolute value, how much each group has changed. So technology and communication services are down 1 or 1.5% on the week. And here we have the defensive sector riding up again. And if we stretch this out, just let's go 1 month, what you'll see was technology was doing really well. So since earnings, we have really not had much performance out of technology. And so that's a little bit worrying. And the fact that these other groups that were underperforming are now some of the top performers should at least indicate that there's some change in trend, because we could have taken this number back for a long time. And these technology groups were outperforming. So here's 129 days starting in October. Tech has been the big outperformer. And even if we just go to the December low, which is roughly 70 days or 80 days, somewhere in there, there we go. Tech was the top performer, and these defensive areas were some of the weakest areas. Well, now that's rotated. And again, if we go back to the past week, we're seeing these areas are outperforming compared to the growth areas of the market. So my concern stems from the fact that there's starting to be a change in scope. And with that, you want to be aware of that. So that doesn't mean to stop trading, but it does mean that when you trade, you need to be aware of the potential for bigger things. Now, I created a video about the Canadian market last night, so it'll get posted on the Canadian Technician later today. And on there, the only thing I think it's worthy of going through is to use some of the ideas and some of the charts in there and apply them to the US side. And obviously, I'll be doing that on the shows over the next month or two as we go forward. But it's also a critical place in terms of the chart, because when we get that big significant gap on the advanced decline line, I think that's this chart, on this advanced decline line, this is the kind of thing we see before big market moves down, not little market moves down. And going back in 2007, we saw it. 2010, we saw it. 11. So there's some ideas there that I think are worth grasping onto. But the bigger picture is this long-term decline in trend. So anyway, through all of that, I think the most important thing for U.S. investors is just be aware that some of the setups are starting to get a little lighter and may not be as bullish. So, so today I thought I'd go through and just try to analyze what is working. And we're just going to use the NASDAQ 100. And there's a couple of different ways to do that. So one of the ways to do that is with the scooter ranking, and literally, this is just best price performer first. And, Qualcomm had that big move. And so with that, we can just watch and see what's taking place. And if we go look at Wynn Resorts, this chart's been working its way higher. It's up, 40% or something in the last 4 months. So it's doing really well. Here's Workday, nice and up and to the top right. So these charts are really flying, and they're helpful. But more importantly is, where do you get on them? And if they were to pull back, what's taking place? Whoa, what happened here? So, don't know what happened there. My other computer just started to kick in. Anyway, so one of the things I want to talk about is working through these charts, and you could use RSI, you can use rate of change, you can use the scooter ranking. And it's going to generate different results. So in this case, I've sorted it by scooter ranking, and the way you do that is just you have a chart list with the NASDAQ 100, and if you don't have that, I'll show you in a second how to get that. But you click on here and just get it to rank in this way, and then you scroll down to the very bottom and hit number in sorted order, and that's going to create these numbers at the front here. So when you want to sort, obviously at different times there will be different things, and some people are rate of change fans, some people are PPO fans, and some people are RSI, so you can sort on whatever you want. And the way to do that is to go down here, and we would grab something from this indexes, and we would just say, here's the NASDAQ 100, and we want to add that, and I've already put it up here. And then you group by the NASDAQ 100. And then the second thing you can do is you could rank by RSI, or rank by rate of change, or rank by PPO, or rank by anything you want to rank by. But in this case, I'm going to use RSI and ROC because I always use PPO. And we're just going to try something different. So here's a rank by RSI, and we're going to run that scan. And as we do it, it should change up here, and we get scan results. And now you want to take that and drop it into a chart list. So I have a whole bunch of scanning chart lists that I use, and I'm just going to take it and drop it into the Dire Straits chart list. And again, I want to save the sort order here, and the reason is because I've now sorted it by daily RSI. And by saving that, so it's going to say what stocks are the absolute strongest right now, and that doesn't print out on this summary table, but it did on the sort table. So now everything in here is based on its RSI. So if we go and change the scooter ranking line to actually, let me do it on a weekly chart first. So we're just going to scroll up here to weekly, and then change this scooter ranking to RSI. And update. Okay, so now we've got the RSI up at the top, and the last thing we'll need to do is apply that style to all of the stocks in the chart list, and we can do that. So really quickly, you can either look at it based on anything you want to do, but this was a 2-line code. This isn't very difficult. Group is, and then rank by. And rank by doesn't have a bracket. That's the only thing to remember about it. And then the other thing, if we wanted to rank by rate of change, these 2 slashes tell the program not to listen or not to follow that instruction. It's a comment. And then it'll actually use rate of change instead. So then we run the scan again. And when the results come in, now we just want to take it and we want to replace an existing chart list. And in this case, I'll go to a different one. So the first one was Dire Straits, and then maybe I'll use George for this one and preserve sort order. And so this data over here that the rate of change it's sorting by is important. And again, in this particular situation, now we want to jump into this chart and we want to plot rate of change. So we're going to go and get a weekly chart first and change it to rate of change down here. And that's going to give us a rate of change line, and you can see, clearly breaking out, and you could scan for new 52-week highs in rate of change or anything like that, whatever you want to look for. But as we do this, we also need to apply that style to the rest of the chart list. So hopefully there's some ideas just really quickly on how to go get new stocks or sort a chart list in a different way. So if you're inclined to sort that way, I think one of the bigger things that you might want to do is, once we have this data, we just want to look at it in 10 per page. So if we just go grab the button up here and click on rate of change, so we have a whole bunch of different ways we can look. We can do chart book, gallery view, candle glance, whatever. And my candle glance is currently set up to weekly. So I've set it up so I can just quickly go through and scan this. Now it doesn't show me the rate of change because I didn't put that on this indicator. So we're going to use the summary page instead. Or sorry, not the summary page, the 10 per page. And with the 10 per page, now that's going to put the rate of change right up at the top there. And if we scroll through, here's Monster Beverage, and its rate of change is one of the better rate of changes. And you can see it's actually trying to break through this 65 level, and the stock is starting to push up, PPO turning up above zero. So that one looks pretty interesting if it could start to break out. And again, some of these consumer staples, if the market was going to roll over, this might end up being a pretty important place to be aware of. And so with the rotation in the markets, if we're going to start to see consumer staple stocks break out, perhaps this is one that could go for a ride. And here's Hasbro, and it had a great report last week, paid a dividend this week. That's what this little dotted line means. And it's coming up here around this 105 level, and you can see a breakout here is pretty important for Hasbro. But their rate of change has started to accelerate here, and it's clearly turning up on the full stochastics. Relative strength has broken this kind of 6-month downtrend and is starting to outperform. And so, as we work through these stocks, we can go through and just pick the industry group. So let's say that we think things are going to move into the defensive area, then maybe you might want to go into healthcare and medical supplies like this one. This consumer discretionary Mercado Libre, I think, is out of Mexico or South America. Anyway, it's a retailer, and it's just been soaring. I was told about this stock 10 years ago, but the really nice entry, I think, in here was the 2016 push. Stopped paying a dividend, but it continues to work its way higher. And so here's healthcare medical supplies. And remember, healthcare had a really ugly plunge in the last couple of weeks. Well, this stock didn't even bother plunging. So it's got great relative strength within its group and looks like it wants to try and break out to higher highs here. And so, we're in a NASDAQ 100 stock. We're in a position where we think the market might pull back. But if it was going to move towards defensive stocks, then maybe something like medical supplies could be helpful. And again, this breakout to new 6-month highs is okay. It's just knocking on the door of breaking through 256 there. Here's Take-Two Interactive trying to break out of a 3 or 4 month base here. PPO is starting to turn up. We talked about these stocks a couple of weeks ago, some of these gaming stocks, and I think Electronic Arts is another one that's pretty good. So here's Facebook, and it has clearly been pushing higher. I don't know that I want to enter Facebook if we're starting to get into a more defensive market structure, but they do have great cash flow and not really affected by market pullbacks or ordinary e-commerce recessions. Okay, so Cerner Technology, this is a software company. This thing's breaking out to new 52-week highs as we speak. Looks a little extended, but put it on your list for a bit of a buyback pullback. Then we've got stocks like this X-ray Dentsply. This thing's been just a beautiful move off the bottom, 35 to 55, and continues to work its way higher. And it sounds like it's dental related. That's pretty recession proof. And look at the rate of change up here. It's really, really, really shooting up to new 5-year highs in rate of change. So maybe they got some new product that's kicking it into motion. So here's Cadence Designs. And again, we're just using, one of the indicators to sort by and trying to bring up some strong stocks and just start to see if there's anything here. Here's NetEase, and it looks like it's trying to break into this 20% rate of change level, breaking through to new 52-week highs as we speak. Perhaps that's another big mover starting to set up. NXP Semiconductor, this one's been rocking and rolling even after the semiconductor pullback. This one keeps working, so that probably suggests there's more strength there. Lam Research, same idea, trying to get through the major topping structure from early 2018, and we're back testing it. So as long as it gets through there, I think you got more room to climb, but I would definitely use this level, this, I'll call it 210 level or whatever, as friction. And if it can get through that, great. And if it can't get through that, I'd avoid. Microsoft, this one's been a ribbon higher, Satya Nadella ribbon. That's the current CEO, and he's doing a great job. Apple, they announced their big buyback program, so for $75 billion, and that would probably support a stock because it's not going to go down much if there's a buyer willing to spend $75 billion in there. So Cintas Corp, this one is just trying to break out to prior highs. And again, the rate of change is still holding up nicely, and it put on a big spike here. What a beautiful ribbon higher. So that one is really nice. Insight. And again, I put all of these together in a minute or two, but the bigger thing that we want to be aware of is the underlying trend might be towards consumer staples or healthcare or something like that. So you might want to try and focus over here. This insight has something to do with cannabinoids and the marijuana segment. So not too sure what, I try not to get too involved in the fundamentals. I don't find it helps me trade. I actually trade worse because I expect more from the stock. Netflix just pausing right here at the $400 level. I still think that's a great company to be invested in. The real question is, will it pull back like it did in that September-October timeframe as part of the FANG trade? Amazon, of course, the big news is Warren Buffett was buying. Well, I don't think he was buying here. I think he was buying down here. So Warren's already up $500 a share, and then they announced that they're into the stock. Lululemon. This stock just keeps working its way higher, and I think it's the move into men's clothes doing that, but it's a retail stock, so I would have trouble if the overall market rolled down thinking that this is going to break. Railroads have been exactly that. They have stayed right on a track higher and continue to outperform the S&P 500. So as long as this ribbon of outperformance holds, I think you want to be long the railroads. Looking at Adobe, what you can see here is breaking out to new highs again, and it's been basing all the way since last September, so an 8-month base, and just pushing to new highs now. I'm not as comfortable that this, I mean, it's a beautiful chart and all that kind of stuff. It's just if the market was going to roll over here, I'd be cautious and not let Adobe give back those highs. eBay, struggling right here for the last couple of months. Perhaps it can start to turn it up. I don't have any real avoidance of the stock, but it hasn't been great in terms of a 2-year return. So I think might be a little rough. Here's Activision trying to turn up. It reported this week and it was down a little bit. But I think holding this $50 level, if you can get back above it, I think these gaming consoles are good. Gaming area is a good place to be for people to do if they don't, if the market slows down. So Charter Communications, again, entertainment. This one's trying to break out to the upside. Synopsis, not as comfortable. Okay, so hopefully that's given you an idea, and then feel free to go and grab the other chart list and do the same thing. But the idea is just trying to find stocks based on whatever your flavor is, to try and sort them in a way that you like them, and then use that information. And obviously, if we're looking for something that's moved quickly, these charts from Qualcomm with the big gap up are going to change the chart and put it at the top of pretty much every list if you're looking for some sort of momentum. The second thing that I would just say here is, as the market pushes back up, and let's say the S&P has to get to 3,000 again, as it tries to push up and make new all-time highs, even if it gets there and starts to do that, that's where I'd be more worried that the market would start to pause again. So just try and take that into account as you're looking across the industry groups. If there was anything that gives me comfort, it's that the U.S. market is so big and broad that I don't get the feeling it wants to pull back hard. But I get the feeling that it's global growth that's the issue. And so just be aware, keep watching the markets around the world for more clues on the U.S. market. So thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific on Stock Charts TV. You can also catch replays on the Stock Charts YouTube channel or on the Stock Charts TV channel, which has a running list of technical charting informational shows.